Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today's Friday. It's October 21st. The market's going to open up in about an hour and 12 minutes. Now, as you can see here, the market's cooling off just a bit. We've got some data coming out this morning. Actually, we don't have any data coming out this morning. Yesterday, we had data coming in. The jobless claims, they were on the low side. Existing home sales were down, but honestly, the big picture right now is earnings. And as I mentioned to you yesterday, we had a lot of companies come out yesterday. I mean, this is all yesterday. I mean, you had tons. And then today, we have American Express coming out ahead of the opening bell. So just to give you an idea of how Amex is looking, let's take a look here. Ooh, down a little bit. Oh, ouch, down 5. That's negative. And remember, they were revised quite a bit lower. They were only looking at 6.6% year over year and revenue up 28%. I'll take a look and see how they've done afterwards. But these are the other stocks that are coming out. You got Verizon today, you got Simple Foods, you got Schlumberger, which is pretty important, and HCA. And these are the earnings per share. And as I mentioned to you guys the other day, so far, 75% are beating the EPS. But the reason they're beating the EPS is not because they're doing so well. They're beating the EPS because they've been beaten down so much. And even with that, they're having issues going higher. The Fed is looking at the core CPI. They've made that very known. And that is going to be the next big report they're going to be looking at. That's going to be coming out in the near term. Let's talk a little bit about global economy, and then we will move on from there. So global shares were mostly lower Friday and muted trading, not training, as in China. Former Prime Minister Boris Johnson is among the several candidates expected to pay for the vote of former Treasury. I mean, this is leader Penny Bourdon. Very weird. I mean, I mean, how long was she been there for? 2 months? China's ruling party Congress is expected to wrap up on Saturday with an endorsement of leader Xi remain in office indefinitely. That'll be very interesting. Japan's core consumer prices rose about 3% in September from a year earlier. That was the highest increase in 8 years. Now, the Bank of Japan has kept low rates for a while, and it's really not helping them at all. Investors remain concerned about inflation, since higher interest rates tend to discourage borrowing and investment, slow down economic activity, and U.S. employment remains strong. That's very important. Latest government data showing the number of Americans applying for unemployment benefits actually fell, which is really good. Now, the healthy job market is sticking point, since suggests the Fed will have to persist in raising rates. Yeah, because if people are working and if higher rates are not impacting employment, then that's a big issue. Now, looking at the bond market, and this is what I was trying to say yesterday, I want to make sure that everybody understood what I'm saying, because here's my point here on the bond market. I got an email about this yesterday, and I said what's concerning me is the fact that the bond market is continuously going down, which means yield is going up. But what I'm encouraged by, and this is what I said, I'm encouraged by the fact that small cap stocks are actually holding on to the previous May or June lows. I said that's a very positive sign. Even the MDY, the mid caps, are holding on. See that? They're holding on. They haven't gone lower. And look at Kathy Woods, ARK. Remember, these stocks are really messed by higher rates, and they've been moving up. Now, Kathy's breaking down, but again, the bond market's like down here. And remember, the bond market and stocks were moving with each other. So the fact that smaller stocks are not cooperating with bonds going lower is a sign that they are coming out of this recessionary environment. So I'm not expecting the bond market to go much lower in the near term. This is really overdone right now, like grossly overdone in terms of price. Now, looking at StockFetcher, and I do want to show you a couple of things today that are happening. In terms of the strongest sectors, you still got energy, healthcare, but you've got industrial and financial ahead of consumer staples. I think consumer staples is going to come up again. Looking at them individually, energy is making new highs right now. Healthcare looks like it's consolidating and possibly moving a little lower. Industrial looks like it's choppy, but moving to the upside. I like industrial. I may start looking more into industrial stocks. Financial stocks are just not looking all that great. Communication stocks looks like they have in fact bottomed out. This was a sector that was really bad. It doesn't look all that bad now. Technology looks like it could have bottomed out right here. This looks like it could have been a swing low. Basic materials looks like it could be a swing low. Consumer staples just doesn't look all that great right now. I'm expecting more consolidation. Consumer discretionary does not look all that great. Utilities does not look all that great. And although in the long term, they should follow the prices on energy stocks. And real estate just looks awful. The question is, was this right here a capitulation? And are we going to break this low? Now, the day this happened was October the 13th. And if you go to QQQ, if you go to October the 13th, which is right here, that's the period we're looking at. And the low there was 254 on the NASDAQ, 254.13. And it looks like we're going to try to test that level. Now, we bounced really, really hard from here. So it'll be very interesting to see if we, in fact, do break that level or not. Now, in terms of stocks, I want to show you the 20-day high, 20-day low. Just not much there to the upside and not much there to the downside, but the downside is starting to heat up. Now, when this number gets above 400 or 500, that means there's a really strong trend to the downside. Until it does, this is just randomness. I mean, this needs to get up to about 400, 500, 600. Then you know the market is close to the bottom. This is just a drift. This doesn't really mean all that much. Now, top stocks in the S&P right now. Top stocks, you've got Conoco, Marathon, Unum, Twitter, Schlumberger, which is coming out with earnings today. You still got Devon. You got IDEC Pharmaceuticals, the same companies that have been leading. And if you look at my modified one, which isn't all that far back, you will see that it's the same song and dance. Not much of a difference at all. I mean, hardly any difference whatsoever to it. You'll see the same stocks: UNUM, COP, Marathon, Valerio, CF Industries, Devon, Marathon, Oxy, the same stocks. All the energy stocks are leading right here. And, excuse me, to the downside, the same usual suspects. VFC, Dish Network, Caesars, Etsy, NVIDIA. I don't like the fact that NVIDIA, but look at charters here. Bed Bath Body Works has been here forever. Netflix is on here. Realty trusts are on here. So we're seeing a mixed market. Now, in terms of volatility, and volatility is something we definitely want to take a look at. It does appear still that volatility is coming out. Now, I'm hoping that this will break below the 28 level, because if it breaks below the 28 level, this would have been another peak just like it has been here. And every time we peak out here, we tend to cool off quite a bit. Also, with earnings being better than expected due to them being overestimated to the downside by these creative analysts, it looks like we're going to get some more sentiment. One of the interesting things that I'm noticing is if you look at XLY, the consumer discretionary sector, you will see that it's still bottomed out at the same place we were in May, June, which was when the U.S. market bottomed out. It hasn't gotten lower. So the fact that we've been able to stabilize around here in consumer discretionary stocks is telling us that we may, in fact, be at the bottom. Or if we do break this level, it doesn't look like it's going to break it too much. Now, last week when I talked about algos, I explained to everybody, and today's Friday, and on Friday we talk about the algo corner. I explained to everybody that on Fridays, not on Fridays, I explained in my algo corner that algos have been taking the second bottoms lower and then stopping people out, stopping retail traders out, and then bringing the stock up. That has been the major shift. Another major shift due to algos has been watching and this is really important. You should pay attention to this. Starting to see highs, right? 20, 30-day highs break down. Before algos, when you had good long-term trends, a trend would develop sometimes for 3, 4, 6 months. Now it's very, very hard to have a trend for more than 20, 30 days. So that's one of the other fundamental changes that algos have changed in the last several years. Markets used to trend a lot better. Because of algos, algos can measure the directional strength of the trend. And remember, with these stock fetcher codes, we're able to see the strongest stocks. So if I'm looking at them, so are algos. So they're able to see trends like this or trends like this very, very fast, and they're able to capitalize on them. So when they start seeing a market running away from fair value, they'll start selling it into it, and prematurely end the trend. So one of the things, so again, just to give you a review, one of the things we've been seeing with algos is stops getting caught up a little deeper, the second bottoms being lower instead of higher, and market directional trends becoming shorter and shorter. Matter of fact, I'll share an interesting story with you. Back in the day when the turtles, the commodity guys, used algos, they were first using 20-day breakouts. And then after a couple of years, more and more, remember this is the 80s, more and more people started using computers. They started trading 50-day breakouts because 20-day breakouts failed. They started calling them turtle soup. Turtle traders, turtle soup, because they would break down so much. So they started going to 20-day breakouts. Then they started going to 50-day breakouts. Then they started going to about 85-day breakouts with standard deviations. That's when I came in. But the two major things shifted with algos has been lower lows now and trends not lasting as long, which means there's more room for reversion to the mean trading systems, which is what I primarily use. Now, to give you some updates, next week is going to be an interesting week. I don't think this Friday is going to end a lot. Next week, we've got a lot of data and we've got a lot more earnings. I'll give you a full update of what to expect on Monday. But before I let you go, here's what you need to know. The Fed is getting ready to make another major announcement on November 2nd. Folks, that's like 12 days from now. Now, it's shaping up to be their most controversial announcement yet this year. Not only that, it could send shockwaves through the entire economy. Now, I'm preparing my portfolio ASAP, and everyone should. That's why I'm going live today at 1 p.m. Eastern Time to share what I believe is going to happen next leading up to the November 2nd rate hike. And I'll reveal my number one sector play too. Follow the link below. Do not miss out. You do not want to miss out. I'll talk to you guys later. Have a great weekend. And don't forget to post some comments below this video. Bye. Talk to you soon. Take care.